Let's talk about the financial perspective, which is probably one of the most critical indicators for most business owners, as it's the direct result of the execution of the strategies. Most KPIs that are measured here obtain the financial perspective of the company, including its profitability, shareholder value, and growth. Some companies have extremely basic financial goals, such as making enough money to remain open and continue working. Still, the survival of the company can be measured through several financial KPIs that can help management check if the company is being sustainable or not. After looking at today's business environment, many business owners have started contemplating whether they should keep determining success according to financial KPIs on their own. Many criticize how close-minded this method can be, as it doesn't allow them to focus on other valuable actions that fall outside of the financial scope. That is why it's crucial to perform periodical shareholder value analysis, as this helps managers predict future changes in the company's cash flow and estimate a rough value of the current financial strat of the company. Many business owners prefer shareholder value analysis over other activities, as it lets them get a better understanding of how the current financial KPIs can affect the company in the long term. Some of the reasons why only looking at financial indicators to determine whether a company is successful or not is because it prevents managers from improving certain aspects, such as customer satisfaction, employee motivation, and even cycle time. Financial KPIs used to be the direct result of a company's operations and procedures, which would make managers believe that if they do everything how it's supposed to be done, they will maximize their financial KPIs. But that just isn't always the case. Nowadays, most managers understand that the company works holistically, and if they want to achieve their desired financial KPIs, they must execute significant changes in other areas of the company. Still, this doesn't mean that understanding the financial perspective is wrong, as it can also help the company understand their management quality. So let's take a look at an example. Between 1987 and 1990, an electronics company decided to make an order of magnitude quality improvement regarding its on-time delivery and overall performance. This translated into its defect rate dropping from 500 to 50 parts per million, and its on-time delivery rising from 70% to 96%. Even with these massive improvements, it didn't represent a real benefit to the company, as the financial results had little to no improvement during that time period. These results and improvements didn't translate into an increase in profit because the company failed to understand how other aspects of its operations affected the financial outcome. Some factors, such as a lack of focus on the marketing of the products, prevented the company from capitalizing on the new operational achievements. Nevertheless, it is difficult for managers to understand why they're not getting better financial results if they don't look at the company from several perspectives before implementing new strategies. This can sometimes be extremely frustrating, especially after investing valuable resources in the latest techniques. Still, the truth is that the results of the strategies aren't being financially reflected, and so they should re-examine them from a different point of view and understand what makes them not profitable. And that's why the balanced scorecard method introduces the other three perspectives, which allow businesses to measure new KPIs and determine which one needs to be improved for their overall success. It's crucial to remember that implementing this method doesn't guarantee financial success, as it's just a way of creating more specific strategies with measurable objectives. So if after using this method, the operational improvements still aren't being reflected in financial KPIs, the company's executives should keep tweaking their strategies and implementation plans. Some of the reason that this problem may happen is that companies fail to follow up their operational improvement with further actions, as sometimes improving aspects such as cycle time and product quality can translate into excess capacity. In those cases, the extra staff must be relocated or laid off to reduce expenses as much as possible. However, this is only one example of several ways operating procedures can affect the company. The real lesson people need to learn is to always consider the correlation between operations and financial KPIs.